Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
This is ETF Market Insights. I'm Danielle Neziol with BMO ETFs. We have Tony Dong on the show today as well. Tony is the lead ETF analyst for ETF Central. He's also a freelance writer. He does a lot of writing about ETFs. Tony, I'm so happy to have you on the show today.
Thanks, Danielle. I'm happy to be on.
But as always, a reminder to our investors at home, we are not providing you any advice today. We're not providing you any investment recommendations. This channel and all our sessions on the channel are about providing education first to really empower do-it-yourself investors to make investment choices that are right for you. Great. So Tony and I, right before the broadcast started, we were chatting a little bit about low volatility ETFs. That's the topic today. You might have heard some buzz about low volatility ETFs. Tony does a lot of writing about them. In fact, he just published another article on Motley Fool about bearish investors that are looking to stay in equity markets and thinking about what kind of ETF solutions might help them navigate choppier markets. So Tony, for investors out there who have never heard about this or might have heard about low volatility investing but aren't totally familiar, what is a low volatility strategy?
Oh boy. So the whole low volatility, we like to call it an anomaly. For those of you who are perhaps a bit newer to finance, generally there's a fairly linear relationship between the amount of risk you take on and your expected returns. And this relationship underpins a lot of the different asset pricing models out there. But there is one exception, and it's an anomaly because it doesn't really make sense. There's a body of research out there that shows that over long periods of time historically, stocks with lower volatilities have produced better risk-adjusted returns than their more volatile counterparts. And there's a few reasons for this. The research is a bit mixed and none of them are really conclusive, but some of the reasons include the fact that, well, behaviorally, a lot of investors favor high volatility stocks because they don't want to use margin and leverage. So the only way they can chase high returns is by doing that. That could lead to a potential overvaluation of these high volatility stocks. Think about Apple, Microsoft, Google, right? And a relative undervaluation of your low volatility stocks. Another aspect is mathematical. Every time you have a drawdown, that is when your stock goes down, the more it goes down, the disproportionately higher return is required to break even from it. For example, if you lose 50% of your investment, it takes much more than 50% to get back up to break even. Thus, when we talk about the geometric mean, low volatility stocks are more advantageous because they suffer less of these deep drawdowns that require more and more returns to get back to breaking even from. And that's just among some of the reasons.
Makes a lot of sense. So we like to say you win more by losing less with low volatility strategies. So Tony, you've written a few articles already about low volatility strategies. There's a lot of investors out there that want to learn more. Why do you think now specifically is a time when investors are searching for types of strategies like this?
Mainly because of the bond bear market of 2022. So prior to last year, your average 60-40 portfolio, which is 60% in stocks and 40% in broad market aggregate bonds, has delivered a very attractive risk-adjusted rate of return. The problem is when interest rates rise, a lot of these bonds carry a fairly high duration, which is a measure of their sensitivity to interest rates. When rates go up, bond prices go down. So when equities and bonds both go down in an environment like 2022, you don't get a lot of diversification benefits. So you have to look towards alternatives. Another reason we're starting to see is that in many of these market cap weighted indices, say the S&P 500, the top holdings are dominated by a handful of mega cap stocks. You might have heard the term Magnificent Seven. So Nvidia, Microsoft, Apple. A lot of investors are worried about concentration risk here, not just in terms of these select names, but also in terms of sector exposure. I think 25% of the S&P 500 is technology. Now, we can make an argument that yes, this is how efficient markets work, and market cap weighted indices are the default way of investing. But naturally, there are people out there who are going to disagree with this. And personally, I don't feel comfortable with having 25% of my equity holdings in one very sensitive sector.
That makes tons of sense. Investors just looking to de-risk portfolios. And I think it's important to highlight when investors, and I talk about this a lot, but it's when you're managing your investment accounts, you're not just managing your return or your potential return. You also have to manage the risk that you're taking on to hopefully get that return. And with low volatility strategies, what we're really trying to bring to market here with ETFs like this is to show investors that they can reduce their risk while still managing return. And returns that actually, and we'll see later in the numbers, can keep up fairly well to the
Absolutely.
top. Yeah. So
I find that the returns are fairly competitive, but a lot of investors only look at the returns. If you look closely at the risk-adjusted returns and the volatility, there's a lot less what I call the ulcer index. I also call it the keep me awake at night index, right? The ups and downs, the ups are lower, but the downs are much higher too. And you get that much smoother sequence, which I think is desirable for people who understand the benefits, but also for people who just say, you know what, I want something that I can leave there and not worry about it as much.
Absolutely. So we kind of talked about a couple terms already, but when we're looking at low volatility strategies or we're analyzing them, there's two important terms, Tony, that get thrown around a lot. And one is beta and the other is standard deviation. Now, these are both market terms that we use to analyze risk, but do you think, Tony, you could just do a little bit of a deeper dive into what these terms mean for our investors at home that will see them as they analyze these strategies?
Absolutely. So these are two complementary metrics that really go into any low volatility strategy. Well, the ones that work. So let's look at beta first. Beta is essentially a measure of a stock's volatility relative to the market, but it accounts for both the direction and magnitude of it. So if you think about the market with a beta of 1 as a wave, and then your different equity strategies are boats. A stock or a boat with a beta of less than 1 would indicate that the boat, on average, is less volatile and sensitive to market swings. If a stock has a beta of 0.5, it's expected to move half as much as the market, whether it's rising or falling. And then you can also get into intricacies like negative beta, where stock, on average, has historically moved in the opposite direction of the market. In the context of low volatility stocks, we are looking for stocks with a beta of less than 1. And generally, you want to go even lower than that to really get into the low beta stocks. Now, the second metric that we want to look at is standard deviation, right? If you think about an investment's distribution of returns, right? Sometimes most of them are in the middle, so it can return on average this much, but some of them tend to swing out to the tails a bit. You can get investments that are capable of big losses, but also big wins. So the ones with a lot of variation there, the ones with a lot of these really fat tails have a high standard deviation. We mean that historically, an investment with a high standard deviation has seen its return fluctuate very wildly around that average, which generally isn't something you want because that uncertainty is behaviorally unpalpable for the majority of investors. I don't know a lot of people that can see their investments swing 10, 20% each way on a frequent basis and still be comfortable with it. Aside from cryptocurrency investors, that's a little bit of a different realm. But putting these two together, when you look at a low beta strategy, you will often see screeners in place to assess historical beta and historical standard deviation. We want to make sure that the stock doesn't move too erratically compared to the market and also doesn't move too erratically compared to its history.
Exactly. Perfect definition. Right. So beta is looking at the risk relative to the broad market. So it's a kind of a comparable metric. And then standard deviation, like you said, it looks at its risk or its movement relative to itself and its own average, the stock or the ETF. And a little tidbit for investors out there, if you're looking at risk ratings on ETFs, this is a standardized model Risk rating on ETFs always use standard deviation, and they use a 10-year standard deviation. So ETF prices that vary very widely from their mean over 10 years get a medium high to high risk, and then ETFs that stay closer to their median value over those 10 years get rated as a low or medium low risk. So that's kind of how we look at the two different types of risk metrics. Now, Tony, when investors are looking at low volatility strategies, they need to do some due diligence because there are a few out there. Every different firm seems to have its own version of a low volatility strategy, and they aren't always the same. So can you maybe describe a few steps that investors should take when analyzing different low volatility strategies, just so they're doing their proper due diligence on these types of ETFs?
Absolutely. The first thing I would always do is assess the strategy of the ETF. And there's really three ways this can go. It can be index based. That is, it's bound solely to an external index, and that rule determines what the ETF holds and how it rebalances. It can be rules based. So the firm itself comes up with its own proprietary rules to govern how the ETF is, or it can be actively managed. So in this case, you have a fund manager making discretionary decisions on what to pick for a strategy. Now, there's trade-offs and benefits to both, but the most common mistake I see investors find is assuming that all low volatility strategies are either indexed, rules-based, or actively managed. There's an incredible amount of variation in this niche, so really do your reading there. The second thing I would look at is whether or not you're actually getting a low volatility strategy, because there are ETFs out there that are minimum volatility strategies. And on the face of it, they sound the same, but they're actually very quite different. So for low volatility strategies, they select for stocks with low betas and standard deviations, and you often see a sector bias towards very defensive sectors like utilities, consumer staples, and healthcare. Minimum volatility strategies, on the other hand, use a fairly complicated mathematical formula to combine different stocks that individually are quite volatile, but when you mix them together and they have lower correlations to each other, may result in a portfolio that is in the aggregate less volatile. So think about it this way. A low volatility strategy is like choosing mild ingredients for a dish, whereas a minimum volatility strategy, you might have some spicy ingredients in there, but hopefully once you've mixed it, it's less spicy on the whole. Now, the problem with minimum volatility is that it's very reliant on more complex models, and you're hoping that these correlations hold true. And as we know, there's a saying when we're in a crash, all correlations go to one. Whereas low volatility, you're not necessarily reliant on that, and the strategies are much simpler to implement. And that's particularly why I prefer them over minimum volatility. Now, that's not saying there isn't a use for both, but you really need to be aware of this distinction, because a lot of people just buy it based on the ETF name, and that can lead you to a bunch of surprises down the road when it doesn't perform as you'd expect.
I love that analogy with the spicy food. It's great between the low volatility and the mid. It's perfect analogy. So at BMO, I wanted to chat a little bit about the low volatility strategy, and something that you've also written about in Motley Fool recently is the Canadian Equity Low Volatility Strategy ETF ZLB. And I pulled up some numbers before I got our team to send me some numbers before we went live today. And it's kind of going back to the beginning of the show, Tony, when you said, with low volatility strategies, kind of the theory there is you can win by losing less. So ZLB has been listed for over 10 years. So it has over 10 years of performance data to look at. So if you're looking at an ETF like that, what's really helpful is you can see how it's managed through different market environments, different rate cycles. So that's always important when doing your due diligence versus an ETF strategy that might have just been listed last year. You really don't know how it's going to work given different types of environments. So the numbers my team pulled for me, I always like to look at what's called an up capture ratio and a down capture ratio. And what this tells you is how much of the ETF is gaining relative to the broad market and how much it's losing relative to the broad market. So over the last 10 years, the broad Canadian equity market has gone up and down, but overall, the ZLB has captured 81% of the growth of the broad Canadian equity market with taking on less risk. And the down capture ratio, it has captured only 51% of down markets over those last 10 years. So that those numbers are kind of show you, and I'm going to get them up on the screen too, because I think it's a powerful visual to see how these strategies can work and can help investors out by staying invested in equity markets, but taking some risk off the table. I do also want to mention about ZLB that at BMO, we've really decided to focus on beta as our risk metric of choice when analyzing securities. We use a rules-based approach. As Tony said, there's sometimes index, there's sometimes very active approaches. BMO, we're in the middle. We use a rules-based approach. So we set our set of rules, which basically say we're looking at a broad market, and we will pick out the lowest beta securities. We look at a 5-year beta metric. So we like to look at the securities over a longer period of time, not just the past year. And then we weight them relative to how high or low their beta is. And of course, low volatility, we are looking for lower beta securities. And we offer our low volatility ETFs in different regional exposures. So ZLB captures the Canadian equity market, ZLU is the US equity market, and then ZLI is the international equity market. And Tony, you are a bit of a fan of ZLB and ZLU, that's right?
Yes, ZLB and ZLU make up the core of my equity portfolio. I have my own reservations about fixed income assets, mostly just when it comes to the asymmetry of their returns. Your upside is basically, well, the bond provider doesn't default and then you continue getting coupons, whereas if the company does really well, I don't get to participate in any upside. So I prefer to use alternatives and rules-based strategies for managing my portfolio volatility with what you mentioned. Sometimes the best way to get ahead is to not trip over yourself in the first place, right? And it's worked out very well for me in 2022, where ZLB, I think, returned completely flat with distributions. I think it was like, I'm not sure, but it was very, very minimal losses. Whereas the broader S&P TSX 60 fell by nearly 6%, and the US market did even worse. Of course, the trade-off is you are going to lag in environments like this year where the NASDAQ is ripping and my portfolio is probably up about 5-6%. But to succeed with these strategies, I think you need to fully appreciate what they're capable of and understand the behavior aspects behind it. If you're a kind of person that likes to chase performance, if you're the kind of person who likes to see those big swings, you need to realize that mathematically that's not good for you. Right. And I'm not suggesting that it's not right for everybody's risk tolerance, but I know for a fact that it doesn't suit me. And I think ZLB's track record stands for itself, even though it doesn't have the same high market cap weighted exposure to Canadian banks and a lot of these outperformers over the last decades, it has still chugged along very well, right? That upside downside capture ratio is extremely favorable. And I think it stacks up well to even some of the true alternative funds I see out there who employ like more complicated market neutral strategies that charge many multiples more in expenses.
Couldn't have said it better than myself. Thanks, Tony. This was a great episode. Thanks so much for doing this deep dive on low volatility ETF strategies with us.
My pleasure. I loved it.
And make sure to join us next week. We have Jennifer Lee on. She is a BMO Capital Markets economist, and she will be giving us an economic overview for investors in 2024. You don't want to miss it. We'll see you next week.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.